After topping a $3 trillion valuation for the first time ever, NVIDIA's recent rally helping propel the S&P and NASDAQ to record highs. Now investors turn their attention to tomorrow's jobs report. Here to talk about all of it is Bryant VanCronkhite, portfolio manager with Allspring Global Investments. Bryant, welcome. Good to have you with us. Let's start at the top and work back. You say that this is a time for investors to begin to rotate toward value stocks. Why and where do you find them?
It's a day the market's very narrow in its breadth, and markets get narrow for one of two reasons, in my opinion. One is fear, and two is greed. And my concern today is that from these emotional points we are today, I think greed, the exuberance of the AI trade, is driving the S&P right now. When we get to these elevated levels, eventually that emotion fades and the market rotates. And typically from these levels, value takes over from growth. And so what I see today is an underappreciation for the value categories. The companies that have true control of their own destinies outside of the broader economy, outside of the AI trade, are being underappreciated today. And eventually investors will care about that. And as the emotion fades, fundamentals will pick up, and we'll see investors rotate back into the value trade, where a lot of amazing businesses exist today at very discounted valuations.
You mentioned three stocks that I assume you consider all from the value category. They don't seem to have much in common. Maybe perhaps only that they are, quote, value stocks, which is to say they're not AI, they're not high tech, they're not a particularly huge capitalization company.
On the surface, they might have nothing in common, but under the covers, they have everything in common. They each have unique competitive advantages based on a unique asset base. They all are going to throw off tremendously stable free cash flow despite the economy and the direction we go through. And importantly, they all have fortress-like balance sheets they can use to drive their own destiny. So as an example, AerCap is the largest airplane leasing company in the world. Through an acquisition of GE's business in the same space, they now are the dominant player. They're going to see tremendous demand stability as the supply of new airplanes continues to fade. They're going to be the biggest buyer at the lowest prices and have the most supply to provide to their clients at much higher prices. And along the way, they'll optimize their asset base by selling planes today that are below book value on their balance sheets, which they can recycle back into buybacks at great prices. That will drive ROE and a much higher valuation. It's a great business, completely underappreciated at today's valuation.
Brian, I just want to quibble a little bit with the idea of rotating into value stocks, because it's been a trade that has done so poorly that there are very few value fund managers really even left. Many who had great track records maybe prior to the last 15 years, some who have more of a natural resources bent and that kind of thing. Value was starting to work right before ChatGPT came on the scene, and now, of course, we've been back to kind of the growth and momentum trade again. There are many who think the sun has literally set on the U.S. value trade. It has set. It is over. It is history. How do you respond to that?
Well, we're honored to be one of the last ones standing, I guess, in the value camp, number one. But number two, I think there's different ways to think about value. Like the quote-unquote old school way of value investing, which is just buying cheap PE stocks, that's basically dead. That doesn't work anymore. There's no reversion trade anymore. We think about value as how does the company use a stable cash flow stream and an underappreciated balance sheet to drive their own destiny. It's not about buying cheap. It's about buying great businesses when they have a unique way to drive a different destiny. Let's talk about another company like Graphic Packaging, for example. An otherwise sleepy, boring container packaging. They're a leader in paperboard. Over the last 5 to 10 years, that industry has consolidated down further and further to a point today where Graphic Packaging is a dominant player in their space, and they've made some choices around which assets to sell, which ones to keep, that have moved them up the quality curve. They now have a much more stable cash flow stream. They have a strategic decision around pricing, which is very different. They've eliminated their commodity exposures, and they're using their balance sheet to optimize their asset base, which will make them the lowest cost producer, and they're innovating to create higher demand, higher uniqueness in their products. That's a unique situation in an undervalued stock, but I'm not worried about the PE. I'm worried about the value they're going to create. That's mispriced today.